Hello, everybody. Um, I am going to try and wing it today. Destiny Fernandez, our normal esteemed hostess and MC, is at the Miss Texas pageant this weekend. So I'm going to try and do my best today. And we have a great guest that's going to make that a lot easier for me. You guys probably already know him. If you don't, Steve Davis from Total Wealth. Steve, welcome aboard.
Thank you. Good to be here.
Yes, and then Jeff is also on vacation this week, so Austin is going to be filling in for Jeff's spot. So we're going to have a little bit of a different group today, but I'm extremely excited about the content we're going to cover, and I think we're going to have a great conversation. All
I'm
right,
excited.
so first of all, the disclaimer. As you guys know, we are not making any recommendations on investments today, so please make your own decisions, but we are going to cover a lot of information that's going to help you make better decisions. But at the end of the day, the decisions are still up to you. That's our policy. That's Steve's policy. We just want to give you the best information that we can. And my name again is Wade Comeaux. I'm the founder and CEO of Catalyst Funding. Austin is our sales manager. He's been with us since about 2017, making a big impact here. And we're mostly going to talk about Steve today and what his business is doing. So I'm not going to deep dive our personal backgrounds. Before we do that, I'm going to give Austin a chance to cover our value propositions, and then we'll dive right into what Steve's doing at Total Wealth and what he sees coming up in the future. So Austin, take it away.
Appreciate it, Wade. So here at Catalyst, we are a one-stop shop for all your investing needs, whether it's hard money, which is the short-term financing to purchase distressed real estate. We also offer permanent financing solutions in-house. So we offer the conventional loans. We're a Fannie Freddie direct lender on the conventional side. We also have 30-year fixed non-conventional loans. We originally started as a real estate investment company. Wade started the company back in 2012, just investing in real estate. And so our company's been involved in thousands of transactions. One differentiator between us and many other companies is that we do have a single point of contact. So you're dealing with one person throughout, regardless of what transaction that you're going through. So if it's the short term, the long term financing, we have the non-QM loans, we have some Airbnb loans. So regardless of what you're looking for, you'd be dealing with the same person. We can actually get you approved on all sides of our business with one credit pull. And we have a 5-star customer review across all social media platforms. We also offer primary residence loans. So if you're looking to purchase your primary residence, if you're looking to pull cash out, which a lot of investors are doing, pulling cash, taking the equity out of their property to fuel their investment career and get ready for what's coming up. So we also have a VIP flip program that you can reach out and talk to us about, have some of the lowest rates for high quality borrowers, as little as 1 point and 9.99%. And we also have non-QM loans for people who have a FICO score, a credit score all the way down to 500. So if you have a 500 credit score, we still have permanent financing solutions for you, as well as the short-term financing. And one of our newest loans to our mix is our short-term rental loan. This is something that we're going to deep dive later on in the presentation. But this is for individuals who are looking to get into short-term rentals and may not be able to qualify with the payment. We can actually offset the debt of the payment using short-term rental income in the market. So we'll deep dive that a little bit later.
Yeah, and that's we have that both for non-conforming and conforming loans. So very exciting product there. Mm-hmm. So to deep dive into our guest's background, Steve has been doing this for 30 years. He's mentored an enormous amount of people. We partner with Total Wealth all the time, and we really like how they educate people, not just in the big picture, but on individual deals, help them find great deals all the time. Our borrowers really appreciate the relationship with Total Wealth. And Steve, I'm looking forward to hearing what are the new and exciting things going on with your group.
Well, I think there's a lot of excitement because we're seeing, the beginning of what could possibly be a recession. And I know a lot of people are going to be shocked when I say this, but we pray for a recession. Recessions are an incredible opportunity to make massive amounts of money in a relatively short period of time, 3 to 5 years. In 2008, 9, 10, 11, I made several $1,000,000 just buying single family homes. And it was one of those situations where I was in 4,000 apartment units. I had said I'd never do single family homes again. Well, when that recession hit, I couldn't resist. And I helped my son buy a group of houses. I was helping my daughter buy a group of houses so that they would have a second stream of income. And it just was phenomenal.
Mm.
The education that I'm putting out to people right now, what we're really studying at Total Wealth Academy right now, is the fact that most people, including real estate investors, lost money during the recession. Yet me and my friends, we didn't. And I had 3 guests on on my radio show in the last week, multimillionaire entrepreneurs. All 3 of them told me stories of how they lost money in the recession. And so what I did was I investigated by asking questions how they lost the money. And it all came down to one thing. They were not investing in real estate. They were speculating in real estate.
Mm.
These were flippers. These were where he had paid full price for the house, had break even cash flow, but he was waiting for it to go up. You know, if you do that, if you speculate with real estate, it's no better than the stock market. You're not going to beat the stock market. You know, the average for the stock market for the last 75 years is 7.5%. The average for real estate appreciation is closer to 3 or 4%. So it's not a good thing to speculate at any time, to be honest with you. The other problem that they had, they were diversified, so they got slaughtered. So now people are going, wait a minute, Steve, I thought diversification was the right thing to do. No, it's not. Andrew Carnegie said over 100 years ago, put all your eggs in one basket and spend your entire life making sure nobody kicks over your basket. But the poor and the middle class quote it differently. They say, don't put all your eggs in one basket. No, diversification is for people who don't know what they're doing. Because if you know what you're doing, you're going to put all your money in one spot, the spot that makes you the most money. Diversification is for people who don't know what they're investing in, which one's going to make the most money. So they put a little here, there. One of them makes them 20%, but one of them loses them 20%. Question is, why didn't they put all their money in the one that made them 20%? Because they didn't know. So what we're studying right now is how to make money in a recession and focusing on building large portfolios of both single family and commercial, everything from senior living to apartments to self-storage, and how the recession is going to help everyone except for one thing, low inventory on single family, which Wade, you had brought that up earlier. That's the missing link. Where are the houses going to come from? But when it comes to commercial, the opportunities are everywhere because everybody sells about every 5 to 7 years.
Mhm.
So that's really our focus right now. All the students are focusing on and preparing for the recession so that they are ready to take advantage of those deeply discounted prices.
Yeah, I really agree with you that so many of the categories of real estate investment had these adjustable rate mortgages.
Yes.
And that is where there's going to be, I think, a tremendous amount of pain. It could be in commercial loans, it could be in multifamily, any of these categories that have these shorter term adjustable rate mortgages. The cash flows are going to be crushed whenever those start to adjust. I think there's going to be some real opportunities there. The only difference is that, there is a real shortage of houses, and then most houses are now on fixed rate loans, right? We'll actually
Yeah.
cover that in a later part of the presentation. So you have 2 real competing forces, right? You have significantly raising interest rates, then you have a real lack of inventory in the single family space. So we'll kind of cover that and how it's going to impact the market going forward. But I'm very excited about what we're covering today.
Yeah, and just one other thing that I'll add to that, and actually heard this from you, Steve, but in regards to diversification, getting in like your basket is real estate, but diversifying within real estate, such as getting some commercial properties, getting some single family properties, and maybe looking into multifamily, diversifying within the same basket is really important as well.
Yeah, Austin, I'm glad you added that. Andrew Carnegie said it very clearly. He didn't say put your egg in one basket. He said put your eggs plural with an S,
There you
in
go.
one basket. He used groups of steel mills, trains, railroads, things like that. We use, like you said, Austin, we've got senior living, self-storage, apartment complexes, mobile home parks, RV parks, and of course, single family.
Great points. All right, let's dive in. And today we're going to talk a lot about single family, but we'll definitely deviate from that. And Steve, Austin, anytime you guys have a point you want to make in other categories, let's certainly do that. We're going to start off with the housing starts data. We often cover this report, but it's really telling to see, housing starts way back in the 60s when the population was far less than half than it is today. And they were building more homes back in 1960 in that entire decade than they built, than were built in the last decade here. And we started to catch up a little bit, but still nowhere near the peaks of the 70s, 80s, or even right before the financial crisis. So there's still a significant shortage of homes out there at the moment. And I did also hear an interesting statistic yesterday that I don't have here, but we always see this, and Steve, you remember in all these previous times of pressure on home prices, the area that gets the most pressure is definitely the higher price point homes. And to your point with the speculation, trying to do these high end flips, that's just an area that if there's any instability in the market, that's where it really starts to get crushed first, right? And there's a lot of instability at the moment. But what was interesting is that the amount of properties in the rent price range, the rental price range, there's actually fewer properties this month than there were last month, which is very interesting, where there's a lot more inventory being increased in the higher price points. So I think that's because still a lot of investors and even hedge funds are buying very aggressively at this time in the single family space. You guys have anything to add on this particular page, or?
Well, I do want to talk about the hedge funds and those guys because they are a riot. They come in, they pay full price for the property, they run them into the ground, and then they put them up for sale. And they're poor investors. They don't see any money. The HOAs now are actually blocking them. HOAs are now blocking them so that they cannot buy more than one house in a subdivision. In fact, some of them are even blocking them from even one house. But yeah, they let them, because they don't know what they're doing. They're great at raising capital. They're great at selling, but they don't know how to manage rental property. So they hire it out to third parties. And we know the 80-20 rule, 80% of property managers are terrible. 20% are good, and the top 4% are great. So they're running them into the ground. Their vacancy rate is way, way up there, where a good property manager a good owner shouldn't have more than 5 or 6% a year. These guys are up at 18, 25. One group had a 36% vacancy rate, and they don't take care of the houses when they're vacant. So this is what got the HOAs up in a roar and went out and they just started telling, hey, we're going to stop letting these guys come in and buy 20 or 30 houses in one subdivision. So I love those guys because they end up selling their portfolios like Zillow did, and they put stuff into the marketplace and we can pick it up.
Yeah, it's funny. I'm sorry, go ahead, Austin.
Yeah, no, I was just going to say the pressure and what's important to those guys, they raise the capital. And what's more important is putting that capital to use, because they would immediately not, they could essentially go out of business if the capital that they raise, they're not putting to use. And that's where you see them just overpaying for houses in markets that they're not familiar with. And to your point, Steve, they hire these third party, people in local areas that, they try to, outsource and do the property management and do the rehabs. And we worked with a couple groups, and unfortunately it was a similar story to how Zillow ended up happening. So it's very interesting.
Yeah, man, Austin, I love your input. You have knowledge beyond your years, and it is fun to listen to you.
Yeah. I appreciate that.
Absolutely.
Means a lot.
One other funny note before we move on from that, I'm sure you guys have seen the statistics that single family landlords, 88% are mom and pop, right? Own under 2
Yeah.
properties. And, you know, the big hedge funds, they've been trying to master this for decades, and they still can't
Decades.
figure out how to do it because it's a very geographic business. Sometimes it's not always easy to do it all over the place at massive scale with tons of employees. It's just difficult to scale. That's why the mom and pops have always had a real ability to thrive in these, you know, owning apartment complexes and single families and being able to compete with the people that have exponentially more cash because it's not as easy to scale as you might think.
Yeah. And then Austin's point is so valid. They get that. I think it's called push investing, where they raise the capital and they've got to get it invested quickly, so they don't negotiate correctly. They don't wait for the right deal. They just buy whatever's on the market. We just sold 5 last year. Wow. So that's 6 months ago. 5 self-storage complexes at full price to a REIT. Full price.
Good time to
Tell
sell.
you what, all of my properties for sale at full price.
Absolutely.
So I love those REITs. I feel bad for the people who invest in REITs because they don't see the profit because, you know, for 20 years.
Mhm.
But yeah, they are a riot.
Yep. They get that 1% management fee, no
Yeah,
matter what, or 2, you know, whichever one they get. So
1% of
Yeah.
8 billion is a lot of money.
yeah,
100%.
even if you're not doing a very good job. Yeah. All right. Next slide. This is very interesting. We talked about this a little bit earlier. It does not go all the way back to the 60s, but it does show the right axis is population, right? So if you look back at the Great Financial Crisis, 2006, 2007, 2008, population was about 310,000. I mean, sorry, 310 million. My apologies, not thousand. That's a little bit off. And then it's gone up about 10%, right? Now we're approaching, not quite 10%, maybe it's 8, 7, 8, approaching that $340 million number. But you can see the number of homes being built is just such a drastic difference despite the population being up. So this is a chart that Jeff found. I didn't get to cover last time, but it is pretty telling that we're still not anywhere near the number of homes being built that was right before the financial crisis. So
yeah,
very
and
similar
if
information.
you look on the chart, in 1994, there were 200 million people in the country and about 1.4 million housing starts. And then if you fast forward to today in 2022, there's 320 million people and there's about 1.7 million housing starts. So as the population is going way up, the housing starts, you know, not so much. And if you average over the last 10 years, it's been even worse, which has been an average of about 1 million housing starts, and the population average was about 300 million. So I really like this slide just because it shows that we have way too many people and not enough houses being built. So this is why I always say buying real estate right now is the best time to buy, just because people get caught up in the small, minute details, but taking action and getting in the game is definitely key.
Yeah, I agree with Austin that you're not even speculating by saying that, Austin. There's not enough homes. It's not guessing. You're not trying to predict the future. It's just a blatant fact. And you're right. You know, I love that joke. When's the best time to buy real estate? 20 years ago. When's the second best time? Today. Well, that is true today, if at any time.
Absolutely.
Yeah, no, I agree 100%. And I talked to so many people. There was people just a year ago that ended up, and even, you know, 6 months ago that backed out of a deal because the cash to close was an extra $10,000. And, you know, the people that end up losing are the people, and you mentioned it at the beginning, are the people that just don't get into the game. With how much appreciation has risen over the past year, you know, that $10,000 extra cash to close is nothing compared to, you know, what what your home would be worth now if you bought a house a year ago.
Yeah.
Next slide, please. Thank you. So this is a very interesting slide. It's a report by Zillow that covers a very broad group, right? Like I think these are this is a group of 100 experts that come from a wide variety of categories, some in academia, some in private industry, and then some from the government as well. And 60% of those housing experts polled don't believe that the market is in a bubble compared to 32% that do. The panel definitely expects to see a short recession by 2024 as the Federal Reserve works to tame inflation. The panel raised home price growth appreciations, forecast for 2022 as demand remains strong, but affordability is greatly suffering as well. Like that's a huge thing, right? Interest rates right now, I think I looked the other day with interest rates going from 4 to 6. If you're going to have, it's the same payment for a $200,000 loan at 4% as a $160,000 loan, at 6. So I mean, that's just a drastic change, right? That's a huge change, and that is putting real pressure. But it's interesting the reasons that they say this, and I'm going to cover the 4, and then we can kind of talk about it as a group. But the recent price growth can be explained by fundamentals such as demographics, shifted housing preferences, and scarce inventory. And housing preferences is what we've seen: migration from apartment complexes and things of that sort to more space because a lot of people are working from home, or they just want to have more space to enjoy at home. This is a really big one. Credit risk remain low due to sound underwriting and mostly fixed rate, fully amortized mortgages. We're going to talk a little bit more about that on the next slide, but it's a profound difference from where I was involved in the previous mortgage crisis, and the underwriting standards were not even comparable to what they are today. A lot more these ARM loans, and then also a lot of interest-only loans back then, going as high as 125% of the value, which was crazy. This next topic is kind of self-explanatory, saying that a bubble implies a crash. But another really big thing is the inflation-adjusted home price appreciation is high but not excessive. So if you're taking, let's just do the math in Houston, right? 16% year-over-year home price growth, but 8.5% inflation. So what's the delta there, right? You're talking 7.5%, which is not drastically more than what it's been over the last 20 years, which has been 6.5 or 6, right? So that's a very important number, and that's another reason that I think this time may be different. Is inflation back in 2007 was 1.5%, right? You didn't have that other very unique pressure increasing home prices because of just simple inflation, right? Everything's costing more because there's too much money chasing too few goods. Anyway, what do you guys think on this particular slide?
You can go ahead, Steve.
The exuberance and the, for lack of a better word, stupidity of paying above asking by 20, 30, and in one house in Austin, $150,000 above ask. I don't know how long that can go.
It can.
I think that people are going to wake up and stop overpaying, even the few that are buying and the few houses that are available. So I see some dip coming, more of a correction than a crash. And I think the word correction, you need to understand, all that means is a correcting of the prices. It literally means exactly what it says. When people are paying 30, 40 above asking, that's going to stop because they're correcting the mistake. So I see a correction. I don't see a giant collapse anytime soon. I don't even know if the recession will cause a giant collapse in the real estate market. So this all makes sense to me.
Yeah, and the only other thing that I'll add, you kind of touched on it just a minute ago, and I think we may talk about it a little bit later, so I won't spend too much time on it. But just in inflation, I think what is it at weighted? I think it's between 8 and 9%, somewhere around there.
Yeah.
8.6, I think.
Sure. So back in the early 80s, the way that the government calculated inflation is different than how it's calculated today. So, back in the early 80s, they didn't take into account the cost of living. There was a lot of volatile things that they ended up taking out of the equation. And so, interest rates at that time were, 16, 17, 18, 19%, and inflation was 17, 18%. So if you were to factor those items back in, like the cost of living that used to be factored in, we would be right back to where inflation used to be in the early 80s. So whenever I'm talking with people, I ask them, why aren't interest rates at at 17, 18, 19%? And so whenever I'm talking with investors, it's almost a gift to be able to still get in right now, given the current environment, an interest rate of 7%. So I just wanted to throw that out there because I think that we're in a time where you can still buy, even though interest rates are a little bit higher, it makes total sense to still invest right now.
Yep. Next slide, please. So this is just that same Zillow article and the projections of home price growth, and I think Steve would probably fall into the group that is in the expecting the correction, and among this group, I might be in a little bit. I'm definitely not in the green here on this axis where I expected to be the same type of appreciation we had. That's very surprising to me to see that, because I think the interest rates are going to put too much downward pressure on that. I'm probably a little bit more slightly below this orange section, or to probably in between the orange and the red, in my opinion. But even the more pessimistic panelists seem to think that it's, like Steve said, more of a flattening, not necessarily a big reduction, which I think is very reasonable with where interest rates are going, especially in the upper price points. I think you're going to see a lot of downward pressure, because the number of people that can afford a $2 million home or a $1.5 million home or a $1 million home is going to be significantly fewer, because interest rates really impact real estate purchasing power. Any other thoughts on this one, gentlemen?
No, I think you said it well.
Yep.
Cool. Next slide I'll cover real quick, and then I'll let you guys chat about it. It's this is an article by Bank of America research analyst Thomas Thornton talking about an analysis of loans during the previous financial crisis, and at that point, only 25% of borrowers had a FICO score above 720, and that number is 75% today. Also, the amount of household debt compared to disposable income has fallen about 30% from the highs of the great financial crisis. Now, we still have room to go there. You know, we're not necessarily where we're at the worst financial time, so I think there's more of an opportunity. But the overall quality of the mortgage debt is far better than it was at that time. And then also the risky adjustable rate mortgages are far less common, representing only 2% versus 21% back in 2006. So areas where I see a lot of, and I'm actually excited about at some future point, like in the commercial spaces or other areas where a lot of people have very short-term adjustable rate mortgages that are going to adjust at some level above prime. And I think there's going to be some real opportunities in that area. I think there's going to be a lot less homes transitioning, because like if you've got a super low rate, why are you going to sell, right? I mean, it's going to be difficult for people to make the decision to do that. There's not going to be as many homes moving for quite a while in a raising rate environment. Any other thoughts there?
All I can say is I totally agree with that, because if you're sitting there with 2.9, 3.5, that's free money. You know, it's not even an inflation rate. Unless you have to move because of a job change, you have to move because of an illness or family, you're not going to see people jumping ship out of loans like that.
It's going to be very hard. I know there are some loans that are assumable. Those are probably going to be pretty highly desirable in a lot of situations, right? I think you're going to see a lot more of that. That wasn't very common in the recent past, but I think that's going to come back and be in vogue again too. If you have an assumable mortgage, that could be highly desirable.
Yeah, and if you have a single family house, and we actually were putting together a spreadsheet for showing the benefits of doing a cash out refinance, even though interest rates are a lot higher. And then, shouting out your organization, Steve, y'all diversify within real estate. So, you could get into different types of properties, the assisted living, the commercial properties, and, those types of properties that are on loans, like short-term loans, such as ARMs or balloons, it's not going to make sense for them to refinance at such a higher interest rate. So a lot of times you may be able to pick up a lot of those deals here in the upcoming future.
Yeah, we're already seeing that in that some properties that, how do I put it? We've looked at, there was no negotiation, give us our full price. Suddenly they're calling us going, oh, we have changed our mind a little bit and we're willing to negotiate now. So we are seeing that.
Yeah, I think to your point, a lot of those individuals, Steve, unless they have their own personal balance sheet that's super strong, they're going to look at the cash flow And in many of those instances, it's going to be a difficult number because a lot of investors were thinking it's going to keep appreciating so much and rates are going to stay so low. The end of my investment period, I'm going to be golden. And the dynamics have definitely changed.
Definitely.
Yeah, so I'm curious, Steve, what are the in that aspect for like commercial between assisted living, apartment complexes, storage, what are you seeing that most people are tackling right now out of this?
Senior living is huge right now because the baby boomers start turning 80 in 5 years. And that's, again, not speculation. That is happening. So there's going to be a tremendous increase in the number of people that want senior living and assisted living. I think assisted living is going to go through the roof because people don't take care of themselves. They don't exercise. So when they turn 80, they're, on their last leg and they need help. Um, and there's a tremendous number of them, the baby boomers, coming online, and then it's going to continue to happen for the next 20 years.
That makes sense. Are you seeing new builds or are you seeing these assisted living facilities being bought and sold?
I'm seeing a combination. There's not
Okay.
enough of them, so you'll see new builds, but we're buying directly from the bank, mismanaged properties. We buy the note from the bank and then foreclose and then put in a running team.
So a value type play.
It's absolutely a value play. Matt, who leads that side of the company, he just picked up a 80,000 a door. We're paying more than that just for apartments, and he picked up a senior living 80 grand a door.
Wow.
I think his internal rate of return is up above 40% on that deal.
Wow, that's fantastic.
Not too bad at all.
No, can't complain about that.
That's exciting. All right, we're gonna go to the next slide here. This is just showing appreciation over the last 12 months and shocking numbers. I definitely agree with Steve wholeheartedly. If I'm sure of one thing, I'm almost 100% sure that the numbers are not going to look like this in another 12 months with the interest rates going where they're going. I'm not sure of many things, but I'm pretty sure on that one. But pretty shocking numbers over the last 12 months. Does anything geographically jump out here at you, Steve?
I just always love to look at California. Look at that. I mean, I get it. California's beautiful. It's fun. It's got the beaches. But to pay $1 million for a 1,400 square foot 322, no pool, no jacuzzi, no nothing. I mean, they are an anomaly. I think 54 makes sense. 28, looking at Oklahoma, 31, 24. Look how conservative and stable. I guess that's orange, including Alaska. The orange states are, and then and where it's going to be, if we do get hit, or when we do, I guess it's not if, it's when. When we do, Texas is going to be the last one because we're so strong, our economy so diverse. We'll be the last ones to hit. We'll see it coming and be able to mentally prepare for it. California is going to get hit rapidly, and I don't think they're going to be prepared for it.
I think that's a great point. I think there's going to be a lot of geographic differences in what happens over the next several years, and it's funny, the population of California is decreasing, and Texas and other states are going up, yet California grew the most. It's a very interesting dynamic, but it is a desirable place in many ways. But we also showed another report actually it was on a LO sales call that we were going over, if you remember, Austin, just going over the historical price drops back in 2007. And like at that time, Texas did not drop that much. And a lot of other states that don't have massive appreciation did not drop that much. California, Arizona, Florida, big, much larger drops than the steady and slow states that just kind of don't seem to have the big jumps, but also don't have the big drops.
Yeah, this is why we're looking at Phoenix heavily, because, and I plan on going on the radio in Phoenix in the next month or so, because it's going to drop, but you've got conservative values there, and you're going to be able to make huge amounts of money in Arizona. Now, I just speculated, which I hate doing, but I do love Arizona. Um, I love their politics, and I love the fact that they went up 96. When that correction comes, there's going to be massive opportunity there.
Yeah, they are definitely a state that has gone up and down more rapidly than some others. But I do agree with you that they have a lot of really good dynamics in their economics coming up in the near future. So good stuff there. All right, our next slide. Historic mortgage rates. Just as a reminder, it's very painful at the moment where rates have gone from where they were even 3 or 4 months ago. But historically, we're still at the lowest rates that we've ever had. And it's shocking to see this whenever you think how frustrating it is to go up, 2% in interest rates in a couple of months. But these numbers are still incredibly low. And, people made a lot of money in real estate whenever it was back in the 70s and all these different times whenever interest rates are far higher. It's just the buy price has to adjust, right? You can't pay such a premium, to Steve's point earlier, if interest rates are not as low.
Correct. And yeah, I know people are frustrated with the increases, but anything under 7%, you really shouldn't be whining. It's just still a good deal. Once it gets 7.5, 8, you can whine a little bit, but just negotiate a little harder, be more patient, skip a few deals till you find the right one, and keep plugging along.
Yeah, definitely. And I'll just add on to that and say that, interest rates are still, historically low whenever you're looking at this chart. And as interest rates continue to increase, and this is why I always hit on the fact of getting into the game now, because if you can lock in at a 6-7% interest rate and interest rates do continue to go up, what naturally happens? People have to raise the rents. Investors have to still cash flow. So as interest rates go up, rents are going to go up. So if you get in now, you're going to be able to capture that extra monthly cash flow. Now, in a few years, if something crazy happens and interest rates do go back down, what can you do? You could refinance, lower your interest rate. So getting into the game now is key.
Yeah, and people, that's a really good point, Austin. Everybody listening, remember, if you take it at 6%, in a few years, they're going to lower it back down, refinance. So be prepared for that. Make sure you keep your credit clean. Make sure you keep your debt to income ratio where it should be so that when the rates drop, you're ready to do that. And you may be pulling out some cash at the same time.
Yep.
Exactly. Yep. Over time, you get appreciation. You get somebody else paying your note down, and you get your monthly cash flow. There's so many reasons, tax write-offs. There's a lot of reasons to, continually buy real estate.
Absolutely. Next slide. Steve, I know this is your hometown just like it is ours, but anecdotally, what are you seeing in Houston and what jumps out to you on this chart?
Well, I'll jump back to my members. The members are doing 2 or 3, but it was low. So 2 to 3 times as many deals is still low. Now I'm starting to see more members calling me with deals than I did 3 months ago. I don't see deals going above market value anymore. So I'm not sure, that's my first glance at this. Everything, 1% change, which is no change.
Right.
Total dollar volume, 12%. So because prices have gone up, total active listings, still low, still low. You know how many listings we're supposed to have, and it's supposed to be closer to 75,000?
Yeah, I mean, equilibrium in a market is 6 months of inventory. That's one number I
Yeah.
always look at. Now we're increasing,
Oh,
right?
we're
We were at
1.6. Yeah.
Yeah, we were at 1.3 last year, so that's an increase for sure.
Yeah. You're
Um,
right.
but it's still not anywhere near equilibrium. So we have a long way to get to what's called an equilibrium in the market, and then a buyer's market would be where there's 6 months of inventory, which we're not even anywhere close to that, but we are
No.
increasing. It's one other interesting statistic that I like to cover. Pre-COVID single family home rental price was 1768 in February of 2020. They did not updated this last month. It's one of the first times they did it. I'm not sure why. Destiny really worked hard to find it, but in April that number was 2164. So you can see that's like a $400 increase. So what's amazing about that is as a percentage of the rent, it doesn't seem like that big of a deal. But if you were cash flowing $300 pre-COVID, now that number's $700. So as a percentage of your cash flow, it's shocking, right? It's a huge win, and I think rents always lag home price appreciation a little bit because you have these long-term leases. So we're hoping to
Yeah.
still continue to see it. We need it candidly because taxes have been going up so much. There's been a lot of pressure on cash flow because of the tax increases, but I do believe the rents are really going to start to hit. Anything to add
Yeah.
there before we go on to the next one?
Now, I'll just reiterate what you said. Rents are going to continue to go up. Um, Houses that, like you said, you bought them with $400 a month cash flow. They're now at 700. I don't think it's going to stop till it's around another $200 per single family house.
Yeah, and I do just want to point out, I was looking at the last month's update, and April 2021, very similar to what it was in April 2022. Now, we see here May 2022, we had 24,000 active listings, and April 2022, last month, we had 22,000 active listings. Now, if you go down to pending sales, the number is almost identical. So from May 2022 to last month, April 2022, it's almost the exact same number. So I think that a lot of people are seeing, hey, and this is what they've been seeing for, getting houses over ask. And now people are trying to jump in there and try to sell their house now. And you see so many more listings and, not as many properties going under contract. So it's really, that's why I think that we're going to start seeing that flattening a little bit.
Yeah, that's a good catch. I didn't notice that, but you're absolutely right. Fewer single family home sales and more listings.
Mm-hmm. And that inventory, I think, is just going to keep creeping up to a more normalized number instead of these absurdly low 1.3, 1.6. Those are still both crazy low numbers.
Yeah, and you're going to see these, distressed home sellers. They're going to start seeing that, hey, I couldn't get what I could get for my property, 6 months ago. So that's whenever you start seeing investors being able to, get better deals whenever they realize that they can't sell their house for what they could have, 6 months ago to a year ago.
No doubt. So San Antonio, in our opinion, Steve, is like probably right up there with Houston as just an excellent single family area in which to invest, reasonably priced homes, great rents. What is your opinion of San Antonio anecdotally at the moment? And then, you and Austin, do you see anything on this chart that jumps out?
Identical to yours. It's a wonderful place to invest. Great families, great people, especially in that price range, that 1,500 to 2,500 price range. And I'm trying to think of the name, but she's got 20 or 30 rent houses there. Uh, she's got like over 100% occupancy because people will move out on the 15th, having paid the whole month, and their family will move in on the 30th.
Hmm.
I mean, it's just crazy how family oriented these families are, and they take care of the property. Yeah, I love San Antonio. That's all I can say. I mean, it's a great place to invest.
Yeah. The home price appreciation's been a little bit more aggressive than Houston's, which is interesting, but the rent appreciation hasn't been quite as aggressive. So it's But it's catching up. I think it's a very highly desirable area. We like
Well,
it.
she has been raising her rents $100 a unit almost on an annual basis for a while, and she's still below market because she didn't want to hit them with, 400 all at once. She's doing it gradually. So I think that may be what's going on with everybody, and that's why it looks low when really the rent is higher. It just hadn't caught up yet.
Yeah.
Yeah, and looking on the loan side, whenever we're originating loans for investors over in San Antonio is pretty much where Houston was a couple years ago. I think that it's a great place to invest in single family real estate. The average out of pocket that we're seeing over in San Antonio is between 15 to 20, 22,000, which now here in Houston, you're looking at 25, 30,000. Up in Dallas, it's even higher than that. So San Antonio is a really hot area for people to invest in. And I do just want to throw out that our company in particular, we have inspectors and we have a project management team in each of these cities in Houston, San Antonio, and Dallas. And so even if you don't live in the city, you can still invest in the city. And you have our team out there taking pictures, giving a second set of eyes for what your contractor is doing. So even if you don't live in the city, definitely consider investing over there.
Yeah, that's a valuable service.
Yeah, and we do that free of charge, which is a huge value add to out-of-state investors or out-of-city investors. We work with a lot of people over in California that are investing here in Texas, and anytime they request draws before you close on a property, we go out with your repair budget, just double check it, make sure your contractor isn't missing any big ticket items, and then also before we pay out on draws, we're looking at it, and even if, say for instance, your contractor finishes your kitchen and maybe they cut some corners, we're going to say, hey, here's the money for the kitchen, but you may want to have a conversation with your contractor before you pay him out. Here are the photos, here's what we think. So it's a huge value add to investors out of the area.
That's amazing. Really cool.
Like Steve was saying earlier, whenever you're paying $1 million for a 1,400 square foot house, not even in a great area in California, that's a 2-1. It's kind of tough to cash flow. So a lot of those California investors take advantage of some of those, the ability to invest in Texas without having to have boots on the ground.
Yeah, we have some members in California, and they just laugh at me when I ask them if they own any rent property there. The standard response is laughter.
Yeah, it's out of control for sure. All right, let's check out North Texas here. So just a reminder to everybody, the Houston report is like Houston Metro, San Antonio is San Antonio Metro, Dallas is a North Texas. We've looked all over and can't find one just for Dallas. So what's really impressive is some of these numbers are even more robust than the appreciation in Houston, and the days on market are comparable, but the appreciation's been 20.6%. I think it's 16% in Houston, maybe a little bit under that 15% in San Antonio. And this includes a lot of rural areas as well. So Dallas has really appreciated, but it is a tougher market to find cash flowing property. So a lot of those Dallas investors do look at San Antonio and Houston, in our opinion. Steve, what are you seeing up in Dallas?
I'm seeing a lot of Dallas people selling their single families to go into passive deals because the people who listen to my radio show in Dallas, most of them want to move to passive. So they're taking advantage of the high prices and selling and then going into passive commercial investing. But Austin, check this out from your catch earlier. Look at the active listings, up 20%, closed sales down 1.8. It's happening there too.
Mm-hmm. Yes,
yeah, and one thing that I wish was on here was pending sales, because I think the difference between active listing and pending sales is a good indicator on what's happening as well.
Yeah.
It's funny. Each of these reports have different pieces of data, and they do not all align. Like the constant debate between Dallas and Houston and San Antonio over what's the best city. I guess they also want to have their own data types, so they don't all align.
I thought Dallas and San Antonio just argued over who's second best.
Well, that's that may be true. I'm not sure if that's how they look at it, but I think that's how we look at it, right?
Yeah, and just to touch on what you were saying a second ago, Steve, some people are selling their properties, but also what we've been seeing a lot, of course, we're in the lending space, is another way to take advantage of the high prices is doing cash out refinances. You can take
Yes.
so much equity out right now and keep your properties and still be able to cash flow and then put that equity into other, other facets of real estate. And I do want to point out as well that we not only lend in Houston, San Antonio, and Dallas, we do lend all over Texas. So we lend anywhere in Texas. So if you're looking to invest in a smaller, area with less population, we can still help you with that.
And then I want to say something about the one touch, one person handling that. Those of you that don't have a lot of experience with doing mortgages, maybe you've only bought one or two properties so far, that is a huge thing. When I got handed off over and over and over again, and then, Bob doesn't know what Mary's doing, who doesn't know what Luke's doing, that's a pain in the rear. The fact that you guys do that one touch, that is invaluable. I'm telling you, give Catalyst a shot for one of your deals, and you'll probably stick with them.
Yeah, I appreciate that, Steve. And one more thing that I just want to add on is a lot of people who are getting into, these, apartment deals, we can go up to 20 units. We have 30-year fixed non-QM loans that can go up to 20 units. You don't have to, a lot of banks have lower amortization than a 30-year am. And also you have to provide documents yearly a lot of times, like personal financial statements, and it's kind of continually supplying documents yearly. And with our program, once you close, there's no additional documents you have to supply for the life of the loan. You get locked in for a 30-year fixed rate, and the rates on those right now are right at about it's about 7%. So it's very aggressive and right where actually conventional interest rates are. So if you're looking to get into those types of deals, right now is a great time.
Yeah, that is an interesting thing, that the compression of pricing between conforming loans and non-conforming loans, it's really close right now.
Yep.
Were you going to add something, Steve? I'm sorry if I cut you off there, but
No, I was just going to mention that I'm glad you told me you guys do 20 units and below.
yeah.
Yep.
All right, so
Yeah.
now let's cover the last city, Austin, which is it's not as crazy as it was, because this number on appreciation for median sales price a couple months back was 30+%. It's creeping down, which is totally appropriate. Just Steve's point, I think you had a lot of people coming from out of state, and they were like, I'm not going to lose this house. I just sold my house in California for, an absurd amount of money, and I'm going to outbid, even if it's an extra 100 grand over ask. I think I've heard from a lot of agents over there and friends that I know that that's slowing down, which I think is very important. The months of inventory, it was for I think the last year it was around 0.5, 0.6, 0.7, and now it's at the 1.2. So that's coming up very quickly to the level of the other three major metros in Texas. So, and you also, Austin statistic here, let's see if we've got active listings. Look at that number, up 146%.
Wow. That's
And pending
amazing.
sales are down.
Pending sales down 12%, active listings up 146%. Now, in all honesty, if you go back and look at these numbers compared to any other time other than the last year, there's still going to be not very many listings on the market, but it's just so much more than it was a year ago when you could throw anything on the market in Austin, you're going to sell it in no time and get well over ask, right?
Mm-hmm.
Anything else you guys see jumping out here?
I think you hit everything I saw. That active listings up 140%. That's amazing.
Yeah, Austin's a crazy market. The days on market are still, ridiculously low. And yeah, Austin's a beast.
So what, just out of curiosity, are you and your members doing any types of investments in Austin? Is there anything where you see as an opportunity there?
The outskirts. Yeah, little, how Katy is to Houston. You've got all those nice little towns around it. That's the only place we're able to get positive cash flow.
Interesting.
Yep.
Okay.
And you just see so many people from California, coming in and, buying properties over there. There's a bunch of, big companies that are coming into Texas just in general, but Austin specifically. And I think you see a lot of rising, why Austin's so hot. I think it's for that reason.
For sure.
It's a fun place to live. I mean, when you go visit there, it is a blast.
Can't beat it. Live music, beautiful.
Yeah.
Last two slides, and I'm going to kind of cover some overarching things. We did something a little bit unusual this time. I'd remembered back in January where Houston, Dallas, Austin, and San Antonio were ranked here. And, Houston and Dallas were 21, 22 on this affordability index. And this basically shows how affordable properties are in each of these major metros. And if you think about it, Dallas, Houston has amenities comparable to the New Yorks, Miami's, Los Angeles, like very comparable amenities, theater, entertainment, restaurants, nightlife, all these great things, but significantly more affordable, right? And this is why I do believe this is going to be a very geographic, the impact is going to be felt everywhere with these increasing interest rates in the recession, but it's going to be geographic in my opinion. And what's interesting is in January, that's where we were, right? If you go to the next slide, David, if you don't mind. The next slide, Houston and Dallas have slipped down and are even more affordable than before. And to explain, this should be called a lack of affordability index, I guess, if you're at the top. Like number one means the least affordable. It's kind of confusing, I guess, but
yeah.
And it's not that home prices are not going up in those areas. It's that they're going up far more in these other areas. We saw that chart, right? The Los Angeleses of the world, San Francisco's, the Floridas, they've gone up exponentially more than we have here. So I think that's a very telling statistic, how much that has changed in 6 months, that while it is more expensive here in Texas, it has not increased like these other places have. What are your guys' thoughts on this chart or these charts?
I'm really impressed with the affordability, but it almost makes me sad for the people in Miami, New York, Los Angeles. 81% of their income, 80%, 77%. Amazing. How do they, Miami's a fun, beautiful place, but they're going broke just finding a place to live. Crazy. So yeah, just more examples of how consistent Texas is and how stable it is and affordable. Yeah, it's just more indication we're going to have more people moving here.
Yeah, for sure. And if you look at the other, Texas markets that are highlighted in yellow there, Lubbock, Laredo, El Paso, Corpus Christi is a big one. We see people getting deals over in these areas that are, killer deals compared to what you can get in the major metros. And over time, as more people, move here and more corporate headquarters come here, I think, just the population is going to continue to increase and people are going to have to start going outside of the major metros to find houses just because of the, supply shortage, right?
In San Antonio, it was, it's saying pretty steady, but 50. That's pretty impressive. That's a nice city as well. And to your point earlier, Steve, wow, what a great place to invest comparatively, right? You look at all the amenities it has, and then it's so far down that chart. Another interesting thing that kind of jumps out at me, I know Austin's a smaller city compared to a lot of these others here, but you look at the average income in Austin compared to these others, 80,000 household average income. Like other than Plano, no one else is really close to that. And Plano is like a very, very small part, tons of corporate headquarters there. So it's a unique little pocket within a bigger city, but that's a pretty telling number.
Yep.
We are right up against it, and I think we need to get to some questions. Austin mentioned it earlier. I do want to talk very briefly about this conventional short-term rental program. What is very unique about this is debt service ratio is a requirement on all these non-QM loans, and it's always been a challenge for people that want to invest in an Airbnb, VRBO type property because you have to use long-term rents to qualify, because that's what you get, on a what's called a 1007, which is an appraised rent rate. And those do not increase relative to the home price increases. In other words, you got a place down in Galveston, it's $1 million home. You're going to use it as a VRBO. You're not going to have long-term rents that increase 4x over a $250,000 home. It's just not how it works on long-term rents. But this program allows us to actually use data from VRBO and Airbnb to get you to qualify for a conventional takeout, best possible price, lowest possible fees to buy these types of properties. It's a very innovative product. We're super excited about it. We've had to work with a lot of appraisers to get them educated on how to use this other data source, but we've seen out of pockets on homes that are, $600,000, $700,000, $800,000 homes can be sometimes far lower than out of pockets on a $250,000 long-term rental, believe it or not. Sometimes 25K on these deals, instant equity capture of hundreds of thousands of dollars. So it's a very unique product that if you are interested in this space or in this space, please reach out to us so we can give you more detail. Austin, anything to add to that before we move on to some questions? Or
Yeah, I'll just say, if you or anybody that you know is looking for short-term rentals, I don't know if I talked to a bunch of lenders all across the country. I don't know of anybody that can offer exactly what this program is. And to Wade's point, if you don't, you can qualify for a $600,000-$700,000 house, and your debt to income ratio before the payment could be right at 49%, and we could still get you qualified. So the payment doesn't even matter. You could have a $3,000 a month payment, and we're going to offset that. We're going to eliminate that from your debt so you can still qualify. It's a huge deal.
absolutely. I am trying to see these questions here. I do have some coming in. So in the panel's opinion, when do you think the recession will begin? And what are the signs you're looking for? Steve, why don't you take that one?
Oh man, speculation. Every time somebody asks me this, I remind them I don't have a crystal ball. You have to remember, it's not if, it's when there's going to be a recession. So I'm going to have to go with what I've seen in multiple articles, which is around 2024. And it could come sooner, it could come later, but if you have to pin me down on a number, I think it's going to happen by 2024.
I can't disagree with you. I think it may be a little bit sooner than that, but I think it's definitely going to happen. I think you could argue right now that we're already in a recession because it's 2 negative quarters, and I think we were flat in 1 negative.
Yeah.
But I've always think back to that term, can't fight the Fed. It really depends on what the Fed's going to do. It depends on their motivation. What pain are they trying to avoid more, recession or inflation? And if they lower interest rates, then I think you're going to see more inflation, less recession, or even the timeliness of that is going to be impacted. So, and that's often driven by, elections and different things like that. So we really don't know what's going to happen, but I do think the Fed and their interest rate choices and their quantitative tightening or easing is going to have a big impact in that overall equation. Anything to add to that, Austin, before we go to the next question?
Yeah, just on the Zillow article that we had, whenever they took a poll of experts that they were asking, when do you think the recession will start, and 45% said 2023, 30% said 2022, and about 25% said 2024 and beyond. So take it for what you will.
Interesting. This question too, I'm not an expert in this space, and I don't know that Austin is either. So I think this is definitely going to be one for Steve as well. And you may have to reach out to Steve and his team directly, but Steve, just a brief overview. Are there average investors getting involved in the assisted living space?
Yeah, you need about 70 grand or more to get involved with our senior living. But it doesn't require any credit or anything like that. It's purely a passive investment. So if you got 70 grand or more, you're in.
Great. So you guys definitely reach out to Steve. We're going to show his contact information at the end of this. But again, that is the Total Wealth Network, right? Network is the last word, I believe.
No, Total Wealth Academy.
Total Wealth Academy. My bad. Sorry about that.
But first, you got to do the cash out refinance, pull the equity out, and then you go to Steve.
That's right. I like your style. I like your style. If you don't have the 70, we can help you get the 70, right?
Exactly. There you
Um, last question we have here. Speaking of investing in the recession, what are things to look for in buying up properties? Do you think there'll be an uptick in distressed properties?
I think there will, because this is just a fact. People don't take care of their homes. I remember in, 7, 8, 9, I remember buying homes just that were pieces of crap and making them perfect. I was standing in one that was a piece of crap and I went, yeah, this is probably the only one in this neighborhood. I looked through the window into the next house. It's in worse condition than the one I'm rehabbing. I mean, people just don't take care of them. So when they go to sell them, they won't even qualify for a conventional mortgage. So they have to sell them to a wholesaler or to an investor. So yeah, I think that there's a lot of neglect. And if people do start needing to move for jobs, for whatever, there's going to be more distressed property during a recession and otherwise.
And I would say, well, I think there are a lot of competing forces. I agree with Steve that in times of a recession, people have less money to fix up their properties, right?
Yeah.
The average person, the impact of inflation for a person living paycheck to paycheck is exponentially greater than most of the people on this phone who have money to invest, right? Gas prices, food prices, rents, all those things are really crippling. And whenever if you own a home, you have to put a lot of money into maintaining it, especially if it's an older home. So I do think there's going to be some opportunities in that space. To Steve's point, I don't know if there's just going to be massive price drops, but there don't have to be massive price drops to have an increase in distressed properties. Those are kind of two different things, right?
You're right.
Distressed
Right.
properties, we've been having distressed properties on the market for this entire run up. They're kind of separated, but I do think financial duress is going to cause more distressed properties, which is a great opportunity. Austin, anything to add to that?
No, I got nothing. Yeah, nothing to add to that.
Cool. So, and I do want to give one other thing. One of our kind guests did say that the average rent in Houston went up to $22.39. They found that data. Maybe it came out a little bit after Destiny was able to look at it. So I'm just going to tell you how that correlates. Oh, wow. So from April 2164 to May 2239, that's a 24.8% year over year increase on rent. That's a huge jump.
That's huge.
Now whatever guest has said that, I appreciate that. I have not confirmed that information, so I don't want that to be stated as fact. But if that is accurate, that's a very big jump. An all-time high of 2239. So very interesting. Okay, well, really appreciate everybody on the call today. I'm going to go to the oh, we got a giveaway. Sorry, let's do that. The winner of and Steve and his team were kind enough to give this a tremendous value, $500 value on a 1-year membership at Total Wealth, and the winner is David Rowland. David Rowland. We're gonna get that contact information over to Steve and his team so you can take advantage of that membership. And in closing, Steve and his team do a fantastic job. If you have not reached out to them or attended one of their events, really encourage you to do it. They don't just talk about real estate investing. They talk about improving your overall life, every facet of your life, relationships, your financial situation for sure, but so many things beyond that. I think they do an outstanding job. So please reach out to his team.
Yeah, and it was David that won?
David Rowland. We'll send you his information here in just a little bit. Do you already know David? Is he a member already?
No, I don't recognize his name, but it's possible because we have a lot of members. But David, congratulations, and we look forward to seeing you at our events. This membership covers you for an entire year of unlimited question and answer with the mentors. So as you're doing your deals, if you get stuck, you just call the office and one of the mentors will tell you what to do next. And you get an all-day class with me to help you get started. Or if you've already got 20 or 30 houses, that Saturday class, we'll show you how to move to commercial.
Great. Speaking of events coming up, Steve, is there anything you want to let the people on the webinar know today? Anything coming up?
Sure. Next Thursday evening, we have a thing called a Spotlight Night, and we are going to be highlighting some recent deals. Sam Morris is going to do a case study of one of his apartment complexes, and Italo is going, a gentleman named Italo is going to go over how he made 100 grand on a flip just recently. And you get to see exactly what the members are doing. You get exposed to the office, you get exposed to the staff, and you can kind of get a feel for how our educational process works.
Great.
And that's free to members, non-members. Yeah, just go to totalwealthacademy.com/spotlight, totalwealthacademy.com/spotlight, and you can reserve a seat, or you can email me at the email address you see right there, and I'll reserve you a seat.
And Steve, if someone happens to be out of town and they can't make it on site, is there a way to see that if they can't make it to the event itself?
In that case, email me.
Okay.
And I'll make arrangements for it to be broadcast on GoTo.
Perfect. Perfect. Well, Steve, it's always a pleasure, man. Really appreciate your
Always
insight.
a pleasure. Thank you.
Yeah, look forward to seeing you at the next event. Austin, have a great day. Thanks, everybody.
All right, y'all take care.
Bye-bye.